Let's jump right into this explainer and build a rigorous, totally math-backed playbook for predicting a company's true earnings growth. We're going to strip away all the noise, the hype, and that dart-throwing guesswork you see so often, so we can look at exactly how to calculate future growth using a professional, data-driven framework. We are absolutely moving away from guessing and moving straight toward calculating.
Here's the playbook for today. First, the core earnings equation. Next, the 5 paths to growth. Then we'll hit our 3 steps: evaluating estimates, applying corrections, and finally, the reality check.
All right, Section 1, the core earnings equation, which is really the math behind the market.
So to find the true driver of a stock's long-term price, we just need to look to legendary investor Peter Lynch. He hit the nail on the head when he said, sooner or later, earnings make or break an investment. Think about it. Earnings are literally the ultimate gravity of the stock market. I mean, you can have the most exciting, world-changing product out there, but if it doesn't eventually translate into bottom-line profits, well, that stock price is inevitably crashing right back down to reality.
And that perfectly illustrates the basic mathematical constraints governing absolutely every business on Earth. It's simple. Price times units sold minus costs equals earnings. Sure, Wall Street loves to dress it up with endless jargon, but at the end of the day, this absolute foundation dictates every single company's terminal value.
Moving on to Section 2, the 5 paths to growth, or pulling the business levers.
What's super fascinating here is that there are really only 5 practical levers a company can pull to make that final earnings number go up. Literally every major strategic move you read about boils down to just one of these. 1, reduce costs to increase margins. 2, raise prices using sheer brand power. 3, enter entirely new markets. 4, maximize current markets, basically stealing market share. And 5, cut losses by disposing of dead weight. Let's actually look at a few of these in action.
Let's look at that first path, reducing costs. Meta brutally proved how efficiency can just transform a bottom line. Back in late 2022, Meta's operating margin had dropped to roughly 25%. Then, Mark Zuckerberg stepped in, declared a year of efficiency, started cutting jobs, and consolidating space. Notice how that operating margin jumps to 35% in 2023, and then absolutely soars to 42% in 2024.
And the result of all that? By slashing costs, Meta grew their actual earnings by a staggering 169%. Now, what makes this so incredibly wild is that their revenue only grew by about 40% during that exact same period. But because they kept their cost growth to basically zero, all that extra revenue fell straight to the bottom line. It acted as this massive multiplier for their earnings.
Now, for the third path, entering new markets. Let's look at one of the most famous investments in history. Back in 1988, Warren Buffett started buying heavily into Coca-Cola. And why? Well, because a proven American product was aggressively expanding into international markets where, frankly, billions of people didn't yet drink Coke. Those overseas sales exploded, and they carried way higher profit margins too. By 1997, Buffett watched Coca-Cola achieve a 5-times earnings leap, jumping from 15 cents to 82 cents a share. That sparked a 10-times increase in the stock price.
All right, into Section 3, Step 1 of our diagnostic, evaluating estimates and finding a starting point.
So, how do we actually predict if a company can pull those growth levers? Well, we usually start with analyst estimates, but here's a little secret Wall Street doesn't exactly advertise. Analysts are perpetually wearing rose-colored glasses. They blindly cluster their estimates between 10 and 20% almost by default. Your best initial indicator for reality is actually to look at a company's historical revenue growth rate, rather than past earnings. Look, if an analyst is predicting 15% future earnings growth for a company that hasn't even managed a 5% historical revenue growth rate, the odds are heavily stacked against them.
Section 4, Step 2, Applying Corrections, Separating Fact from Distortion.
You see, because you can literally never take an analyst estimate at face value, we have to move to Step 2 and apply some mandatory corrections. First up, you absolutely must correct for one-off events. Take Alphabet recently. They reported a massive $9.11 in earnings per share for a quarter. Incredible, right? But dig in a little, and you'll see that included a multi-billion-dollar paper gain from their stake in Anthropic. Their true operating earnings were actually just $2.85. Projecting your future long-term growth off that distorted $9 figure would completely ruin your valuation.
Second correction, you must adjust for cyclicality. Some industries, think memory chips, airlines, or automakers, they just don't grow in straight lines. They have these multi-year booms and busts. Applying a straight-line growth estimate to a cyclical company during a boom is just a recipe for disaster. For example, during a recent boom cycle, long-term estimates from Micron, a memory chip maker, hit over 130% per year. Statistically, over a 5-year horizon, that's absurd. Analysts were simply taking the next 2 years of a boom cycle and averaging it out as if the good times were just going to roll on forever.
So, before trusting any estimate, run it through this exact 4-point correction checklist to make sure you're measuring the company's true earning power. We just talked about removing one-off events and adjusting for those cyclical booms, but you also need to check for share buybacks or dilution. Why? Because changing the number of shares artificially changes the earnings per share, even if the actual business hasn't grown at all. And finally, account for slower growth as company size increases. It's just the law of large numbers. A massive, mature company simply cannot double in size as fast as a nimble little startup.
Finally, Section 5. Step 3. The reality check, stacking the odds in your favor.
Okay, so you've got an estimate, and you've corrected it for all those distortions. Now you need to see if it actually makes sense in the real world by comparing it against base rate data. When you analyze the top 10,000 U.S. stocks over a decade, the reality is pretty stark. Half of all stocks only manage between 0 and 20% growth. And get this, a full 25% actually see their earnings decline. So if you're out there predicting 30% sustained growth for a company, just realize that only 13% of top companies have ever actually achieved that over a 5-year period. It is a brilliant, brilliant bias breaker.
And because we know deep down that any single number we predict might be dead wrong, we have to stack the odds. To truly protect yourself, never ever rely on a single number. Always force yourself to evaluate a bull case, a base case, and a bear case before pulling the trigger. What's the absolute best outcome? What's the most realistic expectation, and what happens if they totally underachieve? If the stock still looks like a solid value even in your base or bear case scenarios, well, then you found an opportunity with a real margin of safety.
Ultimately, the market doesn't reward storytellers. It rewards rigorous, independent thinkers who rely on hard data over flashy narratives. We've gone through the core equation, the 5 growth levers, and our 3-step diagnostic method to filter out all that Wall Street noise. So, the next time a hot stock crosses your radar, I want you to ask yourself, does this growth estimate actually align with historical base rates, or are you just buying into a carefully crafted hype machine? The math is sitting right there for us to use. The real question is, do you have the discipline to use it?